He is a venture partner at Wellington Partners. This is the VC that invested, one of the VCs that invested in a Lithuanian company called Yplan. And Christian Thaler is going to be talking about top 10 killer questions that you startups should be aware of. And when asked by VC, you should be able to answer them. So please welcome on stage Christian Thaler.
Thanks.
Thanks.
Hi. So, hi, I'm Christian Thaler. Two things I want to get out. I just tweeted that I'm really excited to be here, and I hashtagged Vilnius and Latvia. Of course, I know that it's Lithuania. Sorry about that. Second thing, from the previous presentation, which I thought was really interesting, the top takeaway I took was the 1 to 10 ratio on going from wireframe to designers and then developers. I thought that was really insightful, something that I wasn't acutely aware of. And also in terms of just the last thing David said, great career move if you go to start at a larger startup, work for a couple of years, and then, of course, I want you to start your own companies and then come to me at some point. Just a quick introduction on Wellington Partners. We're one of the larger European venture capital firms. We're investors in consumer internet like Spotify, Halo, but also Yplan, as mentioned, but also up to enterprise software and database technology, etc. I'm here. I spend a lot of time in the Central Eastern Europe region to look for great startups. And some of the things that always come back to me in the questions is, how do you prepare for when you speak to venture capitalists, when you meet them, and this is partially why I prepared this presentation, to address exactly those questions. So I call it the top 10 questions that people should be really prepared for, should have great answers to, and should really spend a lot of time thinking about it. And of course, it's not just 10 questions. In fact, it's many more, but they're like clustered into some top-level questions that make a lot of sense and are really critical. And what I also did, and that's probably the difference to many other presentations that are similar to this, is that I want to give you some reasoning why a VC is thinking like that and why are they asking these questions and what's their thinking. Because just to prepare a great answer is not good enough. You really need to get into the brain of the VC and think like that, like them for a moment. That's actually one conversation I had recently with an entrepreneur, and he said, I don't know how you guys think, and I pitch to you guys, I send you a presentation, and then 2 weeks later, an email, oh no, thank you very much, thanks but no thanks. We call it the thanks but no thanks email, and it's. Question to you, or actually, how many in the audience are entrepreneurs that have raised some money? Good, very good. Okay, that's a few. But when you think about the process that you go through as an entrepreneur, what are some of the terms that come to mind? Domantas, maybe that's just that's for you.
I guess distraction from core business. Okay,
that's very true. But when you think about the transparency of the process, is it a transparent process? No, it's not really. It's what I came up with these it's random, it's a black box, it's kind of foggy, right? You don't really know what's going on, and then until you really engage in a process with them and you speak with them, you meet them, and so that's the reason why I wanted to give this presentation. And it's the first time that I've done this presentation. I've done many presentations, but it's the first time I'm doing this because I really want to shed some light into this. And why are we doing this? And this is a very, very simple slide. So probably no matter how large a VC is and how much deal flow they see, so we get about 1,800 deal proposals per year, investment proposals. And roughly it breaks down to something like this. 50% we really never have an interaction with. We basically send them an email, something along the lines of, yeah, thanks but no thanks. 40%, or maybe it's 30 or 45, there's some interaction. There's maybe a call. Maybe there's some email back and forth. Maybe there is a meeting. Maybe it's at a conference like this where I have a 25-minute meeting with the entrepreneurs. I give them, I ask a couple of questions, but not really deep because we just don't have the time for that. And then we go, I may follow up at some point. You want to get to this, right? You want to get to 10%. The top 10%. These are the companies we spend most of the time with. These are the companies where we ask deep questions. These are the companies where we spend time thinking through the entire problem or challenge. And these are the companies where we will do some, call it a pre-due diligence, call it, reference calls, where we really want to understand the motivation of the founders and what the challenge is. This is where you want to get to. And anything before that, maybe at the 40% stage, you want to be prepared for the questions that I'm going to give you right now and we'll walk through. But at the top 10%, this is where you really have to have these answers really well prepared. So again, just another slide, an intro slide on why are we doing this and why are we so anal about all these complicated things. It's just really, it's about this, it's about the probability of having success. And in our business, you think your business is risky. I agree, it totally is, but ours is just as risky, and we're already spreading the risk, and we're investing, later stage than you are investing your time and your effort and founding the company. But the point is, if just look at this. It's just a combined probability of success. You have sufficient capital. It all goes well. The sales pipeline pans out. Your competition moves as you thought it would move. The customers want the product as opposed to maybe want the product. If all of that is at 80%, and 80% is really high, then the combined probability of success, you see that 17%. And if one of these variables goes down to 50%, then it's just 10%. So fact of the matter is, that's why we really dig into all these assumptions that we will work through. So let's get started. And the way I thought about presenting this is, it's a bit of text, so I don't want to read all the text to you, but I wanted to have it in a way that you can, take some notes, or I'll probably put it on SlideShare later on as well, so you get a feeling for, or you can work through this at some other time. So the way I clustered it is, what's the VC asking? Why are they thinking about, or what are they thinking about, and what are they hoping for? It's like kind of like the best case answer or something like that. And then the question is, why is the VC thinking about it, and what's the reasoning behind the reasoning, right? So some of the standard questions, and this is, I ask, some people might have met me at the company meetings I took yesterday and today, and I might have asked some of these questions. Sometimes I didn't, just because we didn't have the time to go into this level. But these questions are really critical. So, who are the founders? What is their background? What motivates them? What is the team's domain experience? Who are the first key employees, and why are they joining you? Are they just being hired, or do they want to work for you? And these are some, this is the team, let's call it the team cluster. It's the questions that makes me understand, why do you want to do this? And when we look at some of the thoughts that the VC is going through, then what I want to see is that this is not a team. On the accelerator panel, they refer to it as, you guys meet here in a room and you're like, hey, we like each other and we have a great idea. Let's do a startup together. That may work out. Typically, what we prefer more is that, founders have known each other for a longer time. They've worked together. They gravitate towards each other in a natural pull. There is a designated role. There's no competition for roles. It's very clear. The founders have deep domain experience because, we get to the because. And the founders have thought about the problem for a while. They're now ready to solve it. This is what I'm thinking, is what I'm hoping for. And why? What's the because? At the end of the day, it's about the team. The whole a startup will make or break with the team. And you hear it all the time, but why is that the case? It's about team cohesion. It's the ability to solve conflict. Have you guys worked together before? Did you go through Death Valley together? Did you guys, solve real problems? Have you worked under pressure together? Have you figured out who's like a natural leader, and is that the person you want to follow? Because whatever happens, any friction in this whole context will lead to loss of energy, it will lead to redundancy, and at the end of the day, what we want is 100% market success and the focus on that. Anything less than that, you will not be successful. On the domain experience, it's essentially about, are you the learning curve. Any venture is a learning curve, and the question is, am I paying for that learning curve, or did someone else pay for that learning curve? And yes, there are, entrepreneurs are expected to, take that learning curve, and we of course also invest into people that may have done something else before. But typically, founders have thought about a problem for a long time, or they experienced the problem. They just want to, get there. Coming back to the recruiting things, early employees, they send a very strong signal to the market. Are you just hiring a couple sales guys, or do these salespeople really want to work for you because they want to be part of the next big story? And that is a real strong signal. Let's go to the next slide. It's more about the product, IP, competition. So these are some of the formal questions. What's the USP? And it's like you answer, our USP is this and that. It's X, Y, Z, ABC. But why are they asking it? Are there patents and trademarks? Who are the competitors? What's the competitive advantage? What's the unfair advantage? And what we're hoping for is some sort of of course we're hoping for a USP. And there's got to be some tech depth, because without tech depth, anyone can copy the problem or the startup. But if it's too much technology depth, then the whole cycle of innovation and commercializing that innovation is just something that's probably too long. Now, just for the to frame the context, we're talking about internet and software startups here. We're not talking about clean tech. We're not talking about biotech. We're not talking about core tech that really is about 10 or more years of university research that's being commercialized. That's not what we're talking about here. So let's go to the next one, the next column, and why are we thinking about this? Of course, USP will create lock-in, right? Without, I always say, without raping a customer. Patents indicate some technology depth, but if it's too deep, it's just not. It just creates most likely it's going to take much longer. It's going to take a lot more money, etc. So it may not be have the capital efficiency that we're looking for. If you don't really know about your competition, the chance that you don't really know your market is pretty high. And in many products or startups, your competition is actually not the other guy that is working on the same thing. It's not the other company in the same space. It's more like it's do nothing, or it's companies developing their own solutions. That doesn't always work, but a lot of, especially in enterprise software, that's the case. And I look at a lot of enterprise software startups. So the reason that what you really want to think about is, how do you get your customers to buy your product instead of developing their own solution? Let's go to the next one. Again, what the VC is asking. Very formal questions. You think they're clear to answer, but you have no idea how many times people swivel around and just being really intangible. How much is being raised in the round? What's the, do you have any idea about, have you come to a conclusion on a pre-money valuation? Will existing investors participate in the round? What's the planned use of the proceeds? And, what I don't expect founders to be proficient in VC mathematics or in the VC process, but the more proficient they are, the more it tells me that they have thought about what they're doing and they're not completely naive. And so again, right, it's about a certain balance. You know, you should be able to accept a 20–25% dilution. Anything more than that tells me you're desperate. Anything way less than that tells me, you know, you're cocky. So it's be somewhere in the middle there. Never swivel around. I see so many pitches where people tell me, you know, wow, and we're raising anywhere between 1 to 5 million. And I'm like, what is it? It's completely different, arbitrary. It's a big range. You know, you're not, if you are, you know, raising, if you tell me you're raising 2 to 2.5 million or maybe 2 to 3, that's okay. But never say, you know, this is the small solution and this is the big solution. Don't do that, because it basically tells me you don't know what you want. Yeah, this is actually, this is a tricky one, because sometimes VCs prefer existing investors not to participate in the round, and sometimes having the existing investors not participate in the round is actually a bad signaling effect. So it's very tricky. It depends on who your first investors are. It depends on what the preference of the follow-on VC is. And this is something where you have to navigate very carefully. If you're in a situation like that, let me know. It's better something to talk offline about. This is really interesting. Why don't they... why are you talking to me? You know, very often companies clearly seem not to have thought about what kind of money they want to raise and from what kind of investors. You know, companies that are either way too early and that should actually raise some business angel money first, or companies that are way too late and try to raise money from me at just way small amounts. You know, if you make $10 million in revenue and you're like break even, then raising 500,000 makes no sense, right? And typically that's very rare that it happens. But what happens is that founders come to me and they have nothing. They have like 12 slides and they want to raise 10 million. Again, that, you know, sometimes that makes sense, and certainly in Silicon Valley, but very rarely does it really make sense here. So why are you talking to me? What are you looking from me as an value add, as from my skill set, from our firm's combined partnership skill set, and our track record? So think about the why me a lot when you talk to investors. It doesn't have to be, you know, don't spend an hour researching every investor, or probably you should if you talk to some of the larger VC firms, but you should have a very clear idea of how you want to structure the round in terms of which investors you want, how much each stake, and which business angels you want to have involved. Because typically that tells me that you have thought about the process, you have thought about what skill set you want in the company or as shareholders, and who you want to associate with, essentially. This is always a very interesting question. Again, it tells me, have you thought about it or not? A lot of people haven't. You have no idea how many people haven't. Typically, the standard answer is, yeah, we're investing some money into marketing and some money into hiring. But what I sometimes get is, you know, oh, we just want to invest into marketing, but we don't really know yet what our marketing formula is. So once you have cracked your marketing formula, you can throw money at marketing. But probably before that, not a good idea. So if something like 50-50 is okay, it makes sense if you know what your marketing formula is. What I see sometimes, and what makes no sense, is paying back debt or buying out founder shares or even angel investor shares at the very early stage. At the later stage, it's okay, it's totally fine, happens all the time, but not in a late seed round or Series A, because at that stage, the company needs every cent in the company and not into some other people's pockets. Typically not something we're very happy about. So again, why are we thinking about this? it comes down to having a meaningful stake in the company. You know, if you want me to invest at a $20 million valuation, 500,000 euros, and then we have like 0.1% in the company, makes no sense. Typically, investors want what I mentioned here, the 25%. What they're looking for. Again, signal to the market is what I explained before about existing investors. You want to be sure that you have an idea about the preference of the investor that you're talking to. We typically would like to see some participation from the existing investors if they're reputable investors, and if angel investors at the very early stage have too much of a share in the company, we'd very much like to see them in some way diluted. It's just it's VC arithmetics 101. And what I mentioned down here is I want 100% of my money to go into the company, not into someone else's pockets. Again, it comes down to disincentivation. It comes down to people not sharing risk, and these kind of things. Last slide on these questions, and anyone who took count can tell that this is more than 10 questions already. So these are the bonus questions. I'll go through them quickly. What have you learned from the early versions of the product, and why do you care about it? Why do users care about the product and service? What are the major product milestones? What are the features that you want to add by raising these funds from me, and the product development roadmap, right? Again, it's about that you have a clear understanding what you want to do with the money, that you have a clear understanding of your early customer behavior and the MVP product market fit, and what your customers are thinking. Major product milestones is very important because it tells me that you've thought about the product development roadmap. And typically, most of the time in very early stage investing, we're looking at a 12 to 18 months runway. So again, and that goes congruent with the 12 to 18 months of development roadmap that's tied to the current investment round. So you should be prepared to very clearly present a train of thought that underlines the development roadmap in that time frame, and it comes down to the features that you want to add as well, and not have too many features, because then it tells me that the product is too early, but not too little either, because you want to create a bigger and better product. So why are we thinking about this? Again, it's the learning, it's the improvements, it's the iterations that you have done on someone else's tab. And once I come in, you're at a point where the whole thing, of course, is supposed to work better than it did before. Typically, what we don't like to come into is bridge rounds, because it very likely tells me that you have done something didn't go right. Right? Even though it may be a reasonably good company, something didn't go right. You have not reached your goals from the previous fundraising round, and you basically with your back to the wall. So this is also the situations where some non-reputable investors may take advantage of companies. You don't want to be in that situation. Roadmap, again, tells me about current product status and the team's ability to add scale and scope. Have you thought about it, or haven't you? And sorry. All right. We talked about that already. Last point here. You don't want to be. It all needs to make sense and tie into the fundraising round in the next 12 to 18 months. I want to give you some last couple of minutes. Very few general advice on pitching and fundraising. If there's one thing I can tell you, two things. Practice in front of your mirror at home. Practice with colleagues. Practice with other VCs, you know? Don't talk to me first. Talk to me not last either, somewhere in the middle. So go to some other VCs first and practice with them, and then come to me, and you will be you just have practice. It's like theater practice. It's a bit like acting. It's a bit like being able to present more fluently than you were before. And so know your narrative inside out. You got to be able to run down the story in one go. Master the macro stats, very important. I want to know why is the market a certain size, and run me through the assumptions. You have no idea how many people dither around, swivel around, and start getting unsure about their own assumptions. This one, I like this one a lot. I'm a huge fan of people who have a strong presence in the room, but are still humble enough to accept advice, and are still humble enough to really be confident without being cocky. It's basically it's the balance between vision and execution, and accepting that you have to sell the product. No product sells itself. Very few people hit like some inflection point where everything goes by itself. Happens from time to time, but most of the time a lot of hard work is behind that. This is one what I feel, what I see very often is very interesting. We split and we're like, okay, we'll be in touch, we'll think about it, and then you never hear from people again. And our plate is very full, and then all of a sudden things start falling through the cracks, and you realize, oh yeah, a week or 2 weeks ago, we wanted to follow up with this guy or this company, and but didn't he want to send us something? No, he hasn't yet. Or didn't we talk about this and that in the meeting, and why hasn't he followed up on that? So have an answer to every question, and if you don't have an answer to a question for some reason, which is fine, happens, come back to it, no matter how hard it is. It shows us that you took the conversation serious. It shows us that you can think through problems and that you're willing to tackle it. If you let problems or unanswered questions slide, it tells me you're either lazy, you're not attentive, or you don't know, right? But if anyone should be able to solve a problem within a day or two, call someone and ask them. And one thing, I know it's basics, but it's very often, 10 to 20 slides in the first meeting are totally fine. You should be able to do the rest with your narrative. You don't have to have everything written down. I've seen presentations where people come in, first meeting, 60 slides. You will never get there. We'll get to slide 12 and then be out of time. So it makes no sense. Just be sure you do that. Yeah, so I'm almost out of time. Perfect timing is, I'm willing to take a couple questions, if there are any. Yeah. There's one question. Mike's coming.
So, hi, I'm Vitas.
Hey.
Oh, sorry, try to stand away from that. So my question is, the ratio of how many startups you chase yourself versus how many startups contact you, and then compare that the percentage of how many you invest in those. Can you talk about that?
Yeah. So I mentioned the 1,800 startups that we see per year, or the pitch decks that we get. That involves a number of startups that we are actually been in touch with for a while that may come back. Like we didn't invest in the last round, maybe you're interested in this round, something like that. There are always situations like in this conference where I meet startups then that I want to follow up with. Out of the 15 or 18 startups that I'm meeting, maybe I want to follow up with like 3 or 4. So really chasing maybe 20, 30, 40 per year, really chasing. Then there is a big bunch that's like these, we stay loosely in touch, and at some point we may be interested. And then there are the ones that chase us, right? So it's typically the number of companies, we invest in about maybe 8, maybe let's say 5 to 10 companies per year. The number that come to us anonymously, like they, come to our website and say, hey, dear sir, dear madam, I want to send you my pitch. It's none. The number that come through our network, through our venture partner network, through our conferences like this, through other entrepreneurs that refer them to us, that's 100%. So it all comes down to our network. The best introduction that you can get to us is through other entrepreneurs or portfolio companies. That's even best, right? But other entrepreneurs is fine, or angel investors that we know, that we work with. So yeah, it's the network, and then what I mentioned is it's a close relationship. And typically, if we're staying in touch with companies over a certain amount of time, and we keep taking an interest, we keep getting feedback loops, then I consider that chasing. Yep.
I think that's all the time we have left, unfortunately.
All right. Super.
Thank you.
Thanks.